Harish Krishnan is with us, co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. Harish, good to have you with us here. Prashant at the side. Just your thoughts, Harish, on how we are set up. Be constructive, look for ideas, deploy money, or wait. I mean, let's just start with a broader kind of top-down call as a fund house. What's the view, Harish?
So I think we are positively biased at this point of time. We have used this volatility that we've seen in the last 4-5 months to increase our allocation to riskier assets, within various asset classes to capture and benefit from the volatility. So let me now try and get you the context as to why we've done what we have done. So about 6 months back, India was a standout over there that we had a counter-cyclical tight policy, both on the fiscal as well as on the monetary side. You had China, which had already told that they are going to loosen their strings. US, which had told that they want lower interest rates and potentially tax cuts to help their corporates and reshoring back. And in that context, India seemed to be an outlier with a weakening earnings growth profile. Moreover, under 4-5 months in February, we've seen 3 big policy resets. The first policy reset that we saw was on the union budget, wherein we've seen a shift for demand side stimulus, which had been lacking for almost 5 years in the NDA 2.0 budgets, where their focus was always going to be on supply side, be it PLI, be it logistics, be it productivity enhancements, etc. And therefore, that 1 lakh crore benefit to taxpayers, I think marks a very big departure in terms of wanting to stimulate demand. The second big reset that we saw clearly was from the Reserve Bank of India, where we've seen a meaningful pivot, not only in terms of rates, but in terms of liquidity, as well as various policy instruments, that had kind of impinged credit growth over the course of the last fiscal year. We think that, over the course of the next 6-9 months, we are likely to see an improving credit growth outlook going ahead. The third policy reset that we saw was on the currency side. Many people may not really appreciate that whatever earnings growth that we see in India on the nominal terms, a big contributor is on the currency side. So while, of course, currency depreciation at the face of depreciation is a point of worry for various foreign investors, for local investors, the earnings growth, given that almost 55 to 60% of top line of India Inc. is in some sense dollarized, it benefits and therefore can provide a tailwind. So I think a combination of these 3 things today make India, as from a domestic perspective, a reasonably good space to be in. On the contrary, US has gone completely counter-cyclical, wherein they want to exert pressure on their markets, etc. So therefore, we have a situation where there is a potential where a lot of money can go outside. In all of this backdrop, clearly the big uncertainty continues to remain what really is the end game for US in terms of trade, and more importantly, what is the end game for the dollar, which the US administration is wanting to pursue. So these are the 2 big unknown variables that we think about. But we think that, if we take a 2-3 year kind of perspective, we think that these are very good levels wherein we have kind of increased our allocation to equities in, say, some of our funds like, say, Balance Advantage Fund, where we were at about 38% in October in the first 10 days. We are now close to about 70%. So that's the kind of increase that we've done in terms of increasing our allocation to equities, taking into benefit this enhanced volatility.
Okay. So obviously going sort of full throttle on equities now in the BAF, the Balanced Advantage Fund, as it's called, Harish. Great to have you on the show this morning. I want to specifically, call out metals, because sometimes markets can be so counterintuitive. When you talk trade wars around the world, metals is probably one of the most global commodity plays. And actually in 2025, it's the metals part of the market that's done the best. I was just looking at the numbers. The Nifty metal index is up 5%, while the Nifty is down about 3.5%. IT is down some 16-17%. So it's been very interesting. There is the whole Europe theory that's playing out, that now Europe is rebuilding itself. And then we have moves like the safeguard duty, which have finally come through. What is your call? Because this is global cyclical commodities at the end of the day. How are you looking at it tactically, short term, and what about medium term?
Sure. So at the start of the year, we had three dark horse sectors. One of them was private banks, second was metals, and third was cement. Of course, these are 3-year views. It's not necessarily validated or invalidated by what we think has happened in the last 2 months or so. But from a metals perspective, the reason why we have been positive is if we plot the profit pool share, which is the profit of the metal sector divided by the top 1,000 companies' total profit. You will see that it's a very cyclical sector. As of last quarter end, the profit pool share of the metal sector, you have to go back to 2001 to see where current profit pool shares are. They are at their 2.5-decade low in terms of profit pool share. Now, that is point number one. Secondly, we've seen ownership levels in metal stocks being very, very low. Thirdly, as you rightly pointed out, you're now seeing a resurgence of fiscal spending that has been absent in, to a certain extent in China, and it's also been absent in Europe, which have seen a very big U-turn, especially in Europe, wherein they're wanting to stimulate their economies on the fiscal side as well. Now, it has got other implications, but for the real assets, it does increase the potential for demand creation that can come through. So I think a combination of all of these, along with the fact that, again, coming back to my point of dollar depreciation, generally, Indian metals are quoted in dollar terms as far as the revenue is concerned. And therefore, a weaker rupee, to a certain extent, also benefits, the metal complex. So we've been positive on metals as a contra trade. Of course, the move has been very sharp, but we think, over a 2-3 year period, there still is a reasonable amount of, greater alpha creation, we think, from this metal complex.
A couple of things that really stand out from the sectors that you like, which have been underperforming. One is chemicals. I'll get your views on that later. But for now, insurance is something that I'm looking at as well. What do you believe would be the triggers for insurance here, apart from the underpenetration, increasing market share thesis that has been going on for a while now in terms of macros? Are you expecting anything specific coming from the regulators here? Maybe a cut in GST? Do you think that could be a trigger?
So you're right that, from a slightly more bigger picture perspective, we think that sector leadership is likely to change. There's been a dislocation in the market in the last 6 months. Sectors that have done well in the last 3-4 years are not likely to be the leaders in the next 3-4 years. And therefore, we have about 9 sectors where things have underperformed over a period of time. Private sector banks, metals, cement, you've got FMCG, you've got energy, you've got chemicals that you also spoke about. Insurance is the other name, textiles and alcobev. In these 9 sectors, I'm not saying that all these 9 sectors are going to lead in the next 3 years, but pockets within these are likely to be the winners over there. And we think, therefore, insurance companies, there have been a significant amount of regulatory headwinds that have kind of impacted overall, wealth creation over the course of the last 3-4 years. While it's hard to call out when this regulatory phase is likely to come to an end, it's only post facto that we'll know that there is not going to be too much of tinkering. What we are enthused is by the fact that, there is no new player wanting to come into this segment. It is getting more and more consolidated. Profit pools are getting more and more consolidated to the biggies. And therefore, and the fact that, even the best run insurer, which has taken market share gains, which has improved their margins, etc., has underperformed the broader markets by almost about 700-800 basis points annualized over a 3 or a 5 year period, provides us a reasonable margin of safety for us to like the space. So therefore, we are positive on this space. Again, maybe a GST cut, maybe something else. It's hard to say what really can be the catalyst for this to play out. But we think that there is reasonable margin of safety in this space to play out over the course of the next 2-3 years.
I got that. By the way, on the services side, Harish, and especially on the exporter side, export to the US, what's the view? Are there any pockets you like? There was some recent, names like, these are very small, not really small market cap wise now, but recent listing, niche player actually, IKS, and you get the Sigility, or both in the healthcare space, but both completely focused on the US. or any other sort of export businesses which you think are well placed?
So I think, exports can be broadly classified into the IT services exports. You've got the pharma, you've got the textile pack, you've got the chemical pack, and then you've got, say, auto ancillaries and other manufacturing allied places, right? Currently, if I look at the last 6 months, there have been impact on, say, textiles. There's been impact on say, auto ancillaries, manufacturing exports, etc. And there has been lesser of an impact in IT and pharma. Of course, the last few weeks, we've seen some degree of that significant outperformance that we had seen since May of 2024, kind of, going away with the underperformance in the recent times. We think that there is going to be a potential reset of the dollar index. Again, it's a very complicated maneuver that the US administration is pursuing, wherein they want to give the threat of tariffs, but they also want a rupee. They also want a dollar devaluation to a certain extent. Now, this is a very complicated maneuver. I mean, the odds of success, to my mind, are very low. But that is the kind of narrative that they are kind of pursuing at this point of time. So I think over the course of the next 3-4 months, we will get opportunities to deploy in exporters back. I think there's going to be some flux in the near term, but there are some very competent businesses. I think the key question that we need to ask is if there is a permanent kind of a reset of the currencies globally, will Indian businesses be competitive? For example, and this is just a hypothetical point that I'm trying to make, will the IT services businesses be as competitive as they were should the rupee be at 75 to a dollar? These are question marks that we are pondering about because these have multiple business implications. But I think over the course of the next 3-4 months, we will get some opportunities to deploy our capital there.
All right. Thank you so much for joining in with your perspective on the sectors that are likely to do well, the way the markets are poised, and how growth is likely to come from some of the erstwhile underperformers as against the earlier leaders as well. But